Hey guys, how's it going? It's Andy. Today I'm going to be making a video that combines two things that people have really seemed to like recently. People have always loved top 10 videos, whether it be talking about sports stars, whether it be talking about musicians, or talking about stock picks. Top 10s are fun because everyone has a different ranking, and I'm very curious to see how your rankings of the top 10 Dividend Kings compare to the list that I'm going to be putting out in today's video. I'm going to be talking about Dividend Kings, and in my last video, around a week ago, I talked about 3 of the Dividend Kings that I was looking to buy at that moment. Things have changed slightly. The market has had some ups and some downs, and now that my tax return is coming in, I'm going to have a decent amount of buying power coming in. So I wanted to make a top 10 list of the Dividend Kings out there and talking about why I like each of them. Dividends are great because there's a huge variety of types of dividend stocks out there. You have the high-paying dividend stock, stuff that we talked about like QYLD that pays a 12% dividend. Doesn't have the long track record that something like a Dividend King would have. Dividend Kings, for those of you who don't know, is that it's a stock that has raised their dividend payout on a payout, not a yield basis, every year for at least 50 years. So I've decided to go through all of the Dividend Kings out there and rank my top 10 and talk about why I like each of them. Some of the criteria I'm looking at, obviously the longevity is there with all of them. 50 years of increase in their dividend growth, fantastic. We're going to be talking about the dividend yield. Obviously, that's the percentage that you're going to be bringing in as of the current price of me recording this video on March 5th. We're going to talk about how it's done since 1995. 1995 is a day that I pick because it encompasses a bunch of interesting economic conditions. You have the dot-com bubble bursting, you have the financial crisis, you have the pandemic, and it gives an interesting array of different economic periods to compare how the stock has done during that time. And I'm just going to talk about how much I enjoy the stock. I think it's really important to buy stocks that you care about because if things go poorly and it's a stock you don't know a lot about or you've never really heard of, you're more likely to sell it off at a loss. So I think buying stuff that you know is a very important part of my investing strategy at this point. So let's get out of the way. This is a ranking from 10 to 1. Be sure to stick around to the end because my top stock I have continued to add, and I just realized that it's my largest holding in my dividend account. So let's start with number 10, which is going to be ticker symbol FRT, which is Federal Realty Investment Trust. This means that it's an REIT. Currently, it's paying out a dividend yield of 3.6%. With REITs, it's important to know that you're going to be taxed in a different way than normal dividends. This is complicated and it depends on which REIT that you're buying. But with REITs, the general concept is that they are paying out, I believe it's 90 or 95% of their earnings as dividends. That is required of them by US law, and that gives them a lot of tax benefits. For the most part, REITs are going to be taxed in a way that's going to be a return of capital. So say you buy a stock for $20, they pay a $1 annual dividend. Instead of paying the taxes on that immediately, you're going to be paying those taxes when you sell. So your cost basis is going to go from 20 down to 19, and that tax bill is not going to hit you until you decide to sell those stocks. So with an REIT, I think it's important to look at the types of properties that they own. It's interesting because they select suburbs and not major US cities. They pick 9 major US markets and they pick suburbs that are within driving distance of these major cities. They have the longest dividend increase streak of all of the REITs and a very nice variety of income sources. We've seen with the pandemic and the stay-at-home movement how REITs went from being this relatively safe looking place to invest to something that has a lot of uncertainty going forward, as we've seen that people can work from home and still be just as productive, if not more productive at home. So they have 22% of their income coming from office and residential, 24% from essential retail, and 16% from restaurants. So this is a nice spread. So if we do see people stay at home more, they're still going to see negatives from it, but they're not going to see as bad of a negative as if they were essentially only focused on offices, which some of the REITs do. So as I mentioned, dividend yield of 3.6%. They've been increasing it for 54 years. They've had very low dividend growth. In the past year, it's up 0.9%. And then as you go forward, 5-year dividend basis is 1.8%. Not super exciting. The growth, not amazing. The stock has been relatively flat. It has struggled in the past 5 years. Since 1995, it's returned 11.74%. This is an interesting REIT because it is the longest streak for increasing dividends. That's why I put it as number 10 on my list. Then we're going to be going with Target, ticker symbol TGT, which has a 1.6% dividend. And in the past, since 1995, it's up 16.34%. I feel like you don't need to say a lot of things about Target. that's not already known. People know what Target brand is. 54 years of dividend increases. In the past year, their dividend growth has gone up 32.4%, which is a massive spike overall. But then it comes down to 8.4% in the past 5 years. This makes a lot of sense. I try to look between 7 to 12% for my 5-year dividend increases. If the stock price goes up significantly, I'm not that worried about the dividend overall. If you're an older investor and you're more focused on the dividends, you don't want to see the stock price go up significantly very quickly, because it's going to really hamper your dividend yield that you're likely trying to live off of. So Target is one of these stocks that, as a younger investor, the longevity of the company with the dividend is just an additional positive to a stock that's done incredibly well over time. Number 8, we're going to go to Colgate Palmolive, which is ticker symbol CL, which has a 2.3% dividend. And in the past, 27 years since 1995, on an average annualized basis, it's up 10.73%, which is pretty similar to how the S&P 500 has done during that time. CL is one of these stocks that is recession-proof. These are consumer products that are going to be used no matter what the economic circumstances are, and that's why I decided to put it higher than something like a Target. Target has incredible returns, but it's not super exciting, and as the uncertainty of economic times with inflation just seems to increase in likelihood, I think something like a Colgate is super nice to have as something that you can buy it, not really have to worry about it. It does have a dividend yield of 2.3%, which is not, it's not going to blow you away, but it's still pretty good. They've been very flat with their dividend increases over the past 5 years, only being up 2.4%. But overall, it has a track record of outperforming the S&P 500, and this is more of a recession-proof stock and not as much of a growth stock that also pays a dividend like something like a Target. Then at number 7, we're going to go with Lowe's, ticker symbol LOW, which has a dividend yield of 1.4%. I made a video recently talking about Home Depot, and I'll link that above right now. Home Depot is not a dividend king. It had to stop its dividend increases during the financial crisis. Lowe's, on the other hand, was able to continue that, and since 1995, they've returned 17.13% on an annualized basis. So you see incredible returns there. This is not a stock I expected to see on this list, just because with the housing crisis, I assumed that since Home Depot had really struggled during that time, I thought Lowe's would do the same. 59 years of dividend increases, a 1-year dividend growth of 33%, and then that comes down just slightly to 18%. So this is a stock that has incredible growth. The uncertainty going forward, similarly what I talked about in the Home Depot video, pretty up in the air about the future of the housing market. So that's definitely a risk there, and that's why I decided not to put it higher. Number 6, we're going to go with Coca-Cola, ticker symbol KO, which has a dividend yield of 2.8%, but it's actually underperformed the S&P 500 since 1995, returning 7.68% compared to 9.82%. So you might be wondering, why would you put something like this on a list? This is just a stock that it's not going to blow you out of the water with its returns, but it's pretty steady. Obviously, it's a dividend king, which is very nice, and I'm going to put its younger cousin, I guess, further up on this list, and if you know what stock I'm talking about, it makes a lot of sense based off its returns. Coca-Cola is just one of those stocks that I feel like deserves to be a part of my portfolio in a small manner. It has 60 years of dividend increases, 2.4% dividend growth in the past year, which only goes up to 2.6% on a 5-year basis. Coca-Cola is not a stock that's going to double in a couple years. It's just a stock that's going to steadily increase in value over time. It's not something that's going to be a huge part of my portfolio, but I am looking to buy it if the valuation comes down further. Number 5, we're going to go 5 and 4 are two stocks that I think are pretty interchangeable. Number 5, I decided to put Procter & Gamble, ticker symbol PG, just because it has a lower dividend yield of 2.3% and has a return of 11.33% since 1995. And then I'll just kind of lump that in with Johnson & Johnson, which has a higher dividend yield at 2.6% and a higher return of 11.44%. These are two companies that I feel like serve a similar purpose in a dividend portfolio. And the only reason I would consider buying two, I do own both of these stocks. The reason I would have both of them is just in case something like, Johnson & Johnson did have the problems with the baby powder, stuff like that. So buying the two, if they're both holding a similar niche in your portfolio, I think that's fine because it lowers the risk of one stock having negative news that's going to drag, both of them down. Buying both, I think, is fine in this situation. I think diversifying too much and owning too many stocks is a bad thing. In this situation, they operate in a similar niche, and I'm not too worried about it. Now we're getting to the top 3. Number 3, we're going to have 3M, pretty fitting, which is ticker symbol MMM, which has the highest dividend yield of the Dividend Kings out there at 4%, but it has outperformed the S&P 500, bringing in 9.28%. It is down 23% in the past 5 years, which is really why it's lagged. When you look at those metrics for how it's done since 1995, there's an overemphasis on recent returns because it makes sense. If a stock doubles in 1995 and it was $10 and goes up to $20, that looks fantastic at that time. But then it only takes, if the stock's at $200 now, dropping to $150 is a much bigger drop in the overall returns than going from 10 to 20. So I think the overemphasis on the recent returns is going to skew some of the looks at 3M. But this is a company that is going to make a lot of the protective stuff. This is the face mask you're going to be wearing during the pandemic. This is stuff that I'm going to be wearing at work for protection, stuff where I'm chainsawing, stuff where I'm working in the shop. This is stuff that pretty recession proof. Has not had the best returns in the past couple years, but I think the longevity of the company has me not too worried about it overall. They've had very small dividend growth in the past year at 0.7%, and then 5% over the past 5 years. This is just a stock that I really like because it's a high dividend yield for a Dividend King. I think it's exciting because of that. Number 2, it was really tough to put the differences between 2 and 1, but number 2, I'm going to go with Pepsi, ticker symbol PEP, which has a dividend yield of 2.8% and a return of 10.48% since 1995. This is a stock that is going to be a huge part of my portfolio going forward. I think not only does it have fantastic returns over the past 50 years, it also has a great part of my portfolio as being very defensive. The products that PepsiCo are putting out are pretty much recession proof. You're not going to be stopping buying the different chip brands or the Pepsi products that they have if the stock market falls or if the economy starts to really suffer. There's a recession proof stock in my book, and since it outperforms Coca-Cola, that's why it's significantly higher on my list. And I think it's the second highest member of my dividend portfolio, and that transitions into number 1, which is Abbvie, ticker symbol ABBV, which has the second highest dividend yield on this list at 3.8%, and has returns of 22.18% since spinning off from Abbott in January of 2013. This is a healthcare company. They're tied with Realty Income as being my largest dividend holding at this point. Ticker symbol O is not a Dividend King, so that's why I did not make this list. But Abbvie, with its incredible return since 2013, having a very nice dividend of 3.8%, is a huge reason why I decided to make it my top Dividend King if I was ranking them. In the past year, they've increased their dividend by 8.5%, and over the past 5 years, 17.1%. So you've had huge increases in it over time, paying $5.23 per share. They do have a decently high payout ratio of 81%, but based off of it being a spinoff of Abbott and being a Dividend King, I don't see them putting themselves in a situation where that's going to be a problem anytime soon. I think that's one of the huge positives with Dividend Kings is that you can buy some of the higher ranges of the payout ratio and not have to worry about it. If a company has only been paying a dividend for 5 years and is sitting at 81%, I'm going to be a lot more worried than something like an Abbvie that's sitting at 81%, but is a spinoff of Abbott. And when you include both of them together, they've been increasing their dividend for 50 years. So that's why I like these Dividend Kings. They give you a lot of stability in times of uncertainty. And that was my top 10 list. I'm very curious to hear what you guys had to say about my rankings. And I'll put FRT as 10, Target as 9, Colgate Palmolive is 8, Lowe's is 7, Coca-Cola is 6, Procter & Gamble is 5, Johnson & Johnson is 4, 3M is 3, PepsiCo as 2, and Abbvie as number 1. If you made it this far, I really appreciate it. Hit the like and subscribe button and let me know what topic you would like me to talk about in a future video. Thanks for watching. I appreciate all support, and I will see you in the next video.